For decades, the American dream possessed a very specific final chapter. You work hard for 40 years, pay off your family mortgage, and retire to a quiet home under the Florida palm trees. But in 2026, that beautiful dream is converting into a brutal financial nightmare for millions of aging senior citizens. The crisis is not driven by health issues or standard market volatility. It is driven by a sudden, catastrophic explosion of property insurance overhead that is systematically cleaning out fixed retirement budgets. Vulnerable seniors are opening their mail to find mandatory premium renewals that they simply cannot afford to pay. The place they built to secure their peace of mind has officially transformed into an aggressive financial trap. And this is where things get ugly. Imagine spending your entire adult life managing your retirement portfolio with absolute precision. You calculated your Social Security updates and independent savings to cover food, utilities, and basic medical care. But when the private insurance syndicates quietly blacklist your coastal zip code, your fixed calculation completely shatters. Every single week, elderly homeowners near Tampa and Fort Lauderdale are discovering that their annual property protection has jumped to $9,000. This single line item now consumes more than 1/3 of their entire guaranteed monthly income. The mainstream real estate networks keep broadcasting profiles of active, carefree lifestyles inside the local senior communities. But on the ground, retirees are sitting at kitchen tables, staring at bills that outpace their liquid cash flow. Would you be willing to sacrifice your hard-earned retirement comfort just to fund the rising profit margins of corporate insurance underwriters? Granted, affluent seniors who possess substantial out-of-state commercial investments can easily absorb these local cost shocks. Yet, for the independent middle-class individual dependent on a single monthly check, this carrying pressure leads directly to the public fund. When ordinary seniors realize that traditional private companies refuse to protect their homes, they seek refuge in the government option. Citizens Property Insurance, the state-backed provider of last resort. They assume that because a public entity manages the ledger, their fixed housing costs will finally remain stable. But in 2026, this public safety net is suffocating under the weight of more than 1,400,000 active policies. The structural guidelines have been modified, changing this defensive shelter into a highly restrictive system. The state is actively deploying new regulations designed to reduce the size of the public portfolio at any cost. The politicians release confident public notices claiming these transformations are required to ensure the long-term solvency of the state treasury. But the ground-level reality is that elderly residents are losing their stable public protection and getting delivered to unstable private firms. Is it reasonable for a government program to restrict access to affordable protection when you have paid local taxes for decades? Naturally, administrators must balance the total public exposure to prevent a massive credit collapse after a major storm hits the coast. But this aggressive management is pushing independent families straight toward the corporate eviction trap. Many retired citizens believe that once they secure a spot inside the Citizens Network, they are insulated from the private market. But a recent legislative mechanism has taken that security completely away from the consumer. It is called the Depopulation Program. Under these current rules, if a small, private insurance firm offers a premium within 20% of your citizens' rate, you are legally forced to transfer. You cannot object to the transfer, and you cannot choose to remain with the public fund. The catch is that many of these secondary private carriers hold weak financial ratings and possess highly restrictive claims definitions. The public narrative claims this process is vital to return risk to the private sector and stabilize the local economy. But the real-world consequence is that vulnerable seniors are forced to buy low-quality coverage from unpredictable private corporate entities. What protection does your family possess when an administrative mandate forces you out of a secure state fund? To be fair, reducing the state's exposure to catastrophic storm debt is essential for the long-term health of the region. But for a senior citizen living on a strict survival budget, this forced migration initiates a silent bankruptcy. This process is creating a hidden form of financial ruin that is taking over the senior population across the state. It does not involve public court dates, and it does not show up on a standard credit check. It is called silent bankruptcy. Homeowners are forcing themselves to live on a strict survival budget, draining their retirement accounts early and cutting back on essential medical prescriptions. They are sacrificing their physical health and their nutrition simply to pay escalating property protection overhead. The policymakers keep distributing economic reports claiming that household net worth across the nation is hitting historic highs. But ordinary people do not buy groceries with paper home equity. They pay them with actual liquid currency. Is it worth sacrificing your quality of life and your medical safety just to hold the title to an expensive real estate asset? Of course, elderly individuals who receive consistent financial assistance from their adult children are managing to navigate these cost spikes. But for the independent majority, this prolonged cash drain delivers them straight to the banking syndicates. As these carrying costs exhaust the remaining savings, some desperate seniors attempt to drop their hazard policies entirely to save cash. Bypassing the insurance system seems like a viable short-term survival strategy when you are running out of money. But if your home is tied to an active mortgage, the global lending network will immediately deploy a brutal penalty. Lenders use automated tracking compliance systems to monitor the status of every financed residential structure every single day. The moment a lapse in coverage is detected, the bank initiates a process called force-placed insurance. They purchase a temporary policy from their own commercial affiliates and add the 4 times higher premium directly to your monthly mortgage statement. Failure to pay this inflated balance results in the bank moving to foreclose on your property and seize your home. The mainstream real estate influencers always marketed a 30-year mortgage as the ultimate foundation for middle-class retirement security. But in this environment, that contract operates as a legal trap that can strip away your independence overnight. What option does a working-class family possess when a banking algorithm has the legal power to double their housing debt without warning? Obviously, wealthy cash buyers who hold complete title to their luxury estates can completely bypass this institutional leverage. But for the traditional middle class, this constant financial stress is turning retirement into an involuntary evacuation. This continuous economic pressure is driving a historic population shift across the American South. A massive exodus of long-term residents out of the uninsurable coastal zones. Internal migration statistics from the Census Bureau are tracking a clear pattern of retired seniors quietly fleeing the state. They are packing up their remaining belongings and relocating to border states like Georgia, Alabama, and the Carolinas. They aren't leaving because they fell out of love with the region. They are moving because the baseline cost of economic survival has broken their budget. Local politicians love to highlight the wealthy hedge fund executives moving their corporate headquarters to luxury enclaves in Miami. But they turn a blind eye to the departure of the essential workforce, the teachers, the mechanics, and the retired seniors who can no longer afford property taxes. A regional economy that prices out its own productive middle class cannot sustain its long-term real estate valuations. Of course, regional demographic shifts are a normal rebalancing mechanism within a hyperinflated market, and landlocked sectors continue to see hospitality job creation. Yet, this steady flight of independent wealth is leaving a permanent scar on the stability of the local community. If you are watching this report from an independent suburb in Texas, California, or the Midwest, do not make the mistake of looking away. This is not a localized Florida story. This is the structural blueprint for an unaffordable America. The identical risk matrices and corporate financial tools are being deployed inside your home states right now. The private insurance syndicates are rewriting the terms of property ownership from coast to coast, turning homes into elite commodities. The government agencies continue to publish optimistic statements claiming the national financial system remains perfectly resilient. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the weight of hidden costs. Take a hard look at your own property renewals, escrow balances, and local tax assessments this quarter. Are you starting to notice the early indicators of this economic squeeze appearing inside your own zip code? Share your local numbers and your personal experiences in the comments section below so we can track how fast this system is expanding across the nation. The United States has historically adjusted to structural shocks, and new legislative boundaries may eventually step in to protect the consumers. But before those macro protections arrive at your front door, independent homeowners must see the reality of the trap clearly. Subscribe to remain informed, protect your wealth, and we will see you in the next economic report.